Hello agents, hello everyone. So today I'm going to get into something. This is for you commission agents, your independent agents that have to deal with people talking about non-commission products and how great their advisory services are and all that good stuff. So we're going to go ahead and do some basic math. I'm going to compare apples to apples here, a MYGA with no commission and a MYGA with full commission. And I'm going to be very generous and fair to the fee-based line. And then I'll explain it all after that. So let's just jump right into this today. Non-commission fixed MYGAs versus commissionable fixed MYGAs. And we're talking multi-year guarantee annuities right now. Very specific, a fixed annuity, multi-year guarantee. Here we go. The same page one. All right. So here we got, this is a commissionable product right here. We're going to start with the value of $500,000. This commissionable product is going to offer a 4% interest rate, and we're going to run that out. So we're going to assume a 3.5% commission on this right up front. So the agent makes $17,500 and the $500,000 goes to work for the client at 4%. And as you can see how it breaks down here, after the first year, he has $520. There's no fee, so he has $520. In year two, it starts at $520, earns for $548,800, and so forth down the line. You see, ends at $557,965 at the end of the term. That's all guaranteed, assuming no withdrawals, all that good stuff. This is what a client could get should he stick to the deal, earns 4% in a fully commissionable 3.5% product. Okay, now let's bring in the fee-based product, right? So I'm going to give the fee, I'm going to give them a 0 commission, but I'm going to charge a 0.5 point fee, right? And we're going to go 7-year term. So 0.5 point, 7 times, about 3.5, right? So we're going to use apples to apples comparison on a fee. But we're going to give the interest rate of 4.5, right? It's a non-commission product, should have a better interest rate. That's why you'd buy it, right? It's going to sizzle it up. So we're going to look at the 4.5 with a 0.5% fee and see what happens. So here we go. At the end of the first year, we have $500,000 at 4.5. It grows to $522,500, but we got to pay a fee, right? That fee of a 0.5 point. It's going to be on the accumulation value, right? They're not going to take it off the original value. These are based on asset-based trails, right? Basically an asset under management. So they're going to get $2,000. The agent is going to get, in this case, $612 in that year. And after the first year, your accumulation, the client's accumulation will be $519. And as you can see, we drop that $519 over here and we go at 4.5 again. It's $543, $282, $2,716 is the fee. And then you're at $540. So as you can see, pause the screen if you want to look at the exact numbers. I'm just going to get into the end results here, right? So the 7-year, the commission product right up here, 7 years, 3.5, it compounds interest at 4%. It earns $994. It's not even to the 4.5 with the 50-point fee. It earns $994 more. So now we look at the 0 commission, non-commission product, 7-year. It pays a 50 beep annual fee. Interest rate is guaranteed at 4.5. However, it doesn't compound, right? Let's look over here. If you have 522 at 4.5, it would compound, right? You don't. You're at 519. So you're losing the compounding because of the fee, right? Or it's softening, lessening, whatever. So let's look at that over on this page, and we say the interest rate. So 500,000 compounded at 450 would be 680. As you see here, we're at 656. So we're not getting 680, right? So we're earning $994 less than up here, the commissionable product, and we're earning $23,460 less than a true 450 compounding product. So what does this all mean, right? So the client thought he was getting 450. Oh, it's way better than that commission guy was trying to only give me 4, right? Well, in the end, we wind up with a 4% actual return, just as the commission agent promised, right? And just as the client would expect when someone tells them you're going to get a 4%, you wind up with 4%. However, with the fee-based, after the fees come out of that 0.5 point of fee, right? The same amount as that commission, but since it's on the accumulation value, it's going to eat more, right? So it's going to end up at 3.98%. We don't like that as much. It's a $20,000 in fees, whereas the commission was only $17,500. So what's that all mean, right? So what might all that add up to? Adding sizzle, what do these fees really accomplish? They accomplish adding sizzle to the product, extra bonus, higher rates on a rate sheet, and big roll-ups. It sizzles it up, makes it easier to sell for these people selling them, right? It transfers risk from the insured to the insurer to the insured, because the insurance company doesn't have to pay any of this commission, less chargebacks and all that stuff they have to worry about. So it's transferring risk. They like that better. if the client leaves early and stuff. Basically, you're giving an income stream, an annuity to the fee-based advisor. That it really does accomplish. And let's take a deeper look at that. Here's an example from the quote I just ran. A client was earning, after the fees, earned 9.88% or 3.98 of the premium, right? The fee-based agent, earned $2,612 or 52 basis points of the original $500,000 premium. So in the end, the client of this annuity is getting 88% of the benefit and the agent's getting a 12% benefit. So 4.5% annuity is giving gains to the client of 88% and the agent of 12%. The yield's only 3.98%. That's how we get to those numbers. So basically you're buying an annuity for the fee advisor. This is a good thing. He knows he's got 7 years of guaranteed income. If you keep it longer, he's got more, right? So what does he need? How many clients does he need? 8 to equal what you're making, right? On the same thing. And he's got the same amount, but he doesn't even have the 500,000. Okay. So next, contract owner, they lose part of the accumulation value annually. So the fee is coming directly out of your earnings as the client's earnings. So it goes into the accumulation value, as you saw, like 522 became 519 because it comes directly out of there. Now, I'm not a tax person. I don't know anything about that. That's a distribution, probably the way they set it up. I don't know the tax, but if I was buying one, I'd want to know, how does this come out before 59 and a half or whatever? How are these fees coming out? I honestly do not know that question. So if anybody has answers to that, please leave it in the comment section below. That would be great to know. I should look into that. It removes the compound interest, right? We showed that, whereas 4.5 would earn like that higher 600,000, 680 or whatever. It only earned the 650, whatever. So I don't know the exact numbers. You got to go back a screen and look, right? Larger commission to the fee advisor, as we showed, 17.5 went as the 3.5 commission, and the actual fees came out to 22,000, right? And by the way, on this, that 7-year MYGA commissionable, it's not 3.5. You'd be lucky to find 3.5% commission on that. It's more or less going to be around a 2.5 commission, and those fees can cap out at 1%. I was only showing 0.5% just to show it, but I imagine the fee advisors are going to try and pull more than the 1%. That's the understanding I've got from surveys I've taken and stuff like that, and talking to these people. They want 1% a year. Less accumulation value to the client. That speaks for itself. We saw at the end, the client earned $944 or something dollars less than the fee client. So let's look at this again. So this is real life stuff. Current rates as of today, 8/29/22, and of course, subject to change, right? So my 7-year commissionable MYGA rates run from 4.25, that's with an A excellent company, to, with an A plus superior company, to a 4.70 with just a regular A excellent company. So if you want super high quality, it's 4.25, no fee, that's commission-based product. And it's up to a 4.7 on the A rated, 4.25 on the A plus, 4.7 on the A rated. The non-commission product on the A category, A plus is going to get you 4.4, but it's anywhere from 4.04 to 4.4. Actually, and this one had an inverted where the A was lower than the A plus, something to do with the charges internally. But in any case, you're only getting 4.4 at the best here, and we're going to get you 4.25. So if the advisor takes more than a dime fee, it doesn't make sense. The client's actually going to get less. So fee product has limited availability. That's why there's less of them. There's less products, less competition, less rates out there. In this real life environment, a fee of more than a dime annually would not be in the best interest for the client because they'd earn less money. And there's no reason to charge a fee. If I've written these things for over 25 years, if a client 5 years down the road after I made my commission in the first year, or the agent even made the commission, the agent's going to get a call from the client, call their wholesaler like me. We're going to follow up, do whatever we need. We're not asking for a fee for that. It's part of the initial deal. And it's really not that difficult to do any servicing on a multi-year guarantee annuity. So there you go. If you're a commissionable agent, if you work on commission, you need to be able to do this math so that they're not sizzled up in the first year, because non-commission and bonus products, they always look good the first year. But when you do the math and the guarantees down the road, they don't look as good. So when are added MYGA fees worth it? Simple. When the math works out in favor of the client. So when you do the math, if you charge a dime, hey, they're going to wind up with a nickel. Hey, that's fine. So you made a 70 basis point commission. That's fair, and that's how you get above it. Or work with the commissionable products, and you're going to make more money and give the client more money. If you try to make more money on a fee product, you're probably going to give the client less money. So in the end, we're here to do the best job for the client. Yeah, that's that. So this is some important information regarding annuities. You can pause it there. And overall, I just want to, here, let's lower this music a little for a second. I just want to say, agents, if you have this question, or if you're in a fight with a commission product, or you just want to put it out there, don't buy a non-commission fee-based product without talking to me first. Something like that. Compare apples to apples. And you can see it's the coolest thing about a MYGA is that it's all guaranteed, laid out in front. I can go from 2 to 10 years and tell you exactly what the deal is. So if you tell me what those fees are, we're going to tell you exactly what the accumulation value is going to be. And they should be able to run those illustrations. That's a wild west over there in the fee-based world. They're showing illustrations with the full value. They should show the what's coming out in the fees and then show the true values. They should quote the interest rates after fee. So if it's 4.5 and you're charging a half a point fee, that's really 3.98, and that should be disclosed up front. And if it's a full fee, guess what? It's even, if it's a full 1% fee, it's even lower than that. It makes utterly no sense at all. So in the end, give me a call. We'll do the math for you. Math is my favorite. It always tells the truth. So hope you're all having a good week. Happy Monday. And I'm here for you, agents. If you need anything, feel free to give us a call or email. Check us out on LinkedIn and YouTube for the most up-to-date information. Thanks again. Bye-bye.